2025, Arizona's once scorching housing market is cooling faster than a desert sunset after monsoon rains. Cities that saw home prices skyrocket from $250,000 to over $550,000 in just 2 years are now watching values tumble by $40,000, $60,000, even $75,000. Mortgage rates hovering near 7% have turned affordable dreams into debt-fueled nightmares, while rising inventory and price cuts sweep across the state like wildfire. From booming suburbs to mountain retreats, no corner is safe. This isn't just a dip, it's a full-blown correction. Let's dive into the 10 Arizona cities where home prices are crashing hard and fast in 2025. Number 10. Avondale. Avondale might not be the first name that pops up when you think of Arizona's real estate market, but in 2025, it's quietly becoming one of the riskiest places to own property. Just west of Phoenix, Avondale saw home prices skyrocket during the post-pandemic boom. In 2020, the median home price hovered around $270,000. Fast forward to mid-2022, and prices had soared to nearly $430,000, a jaw-dropping 59% increase in just 2 years. That kind of growth is rarely sustainable, and now the correction has begun. As of early 2025, prices have fallen back to around $385,000, a nearly $45,000 drop from the peak, or about 10.5%. Inventory tells another part of the story. Listings in Avondale have surged by more than 40% year over year, with homes now sitting on the market for an average of 49 days compared to just 18 days in early 2022. That's a 172% increase in wait time. Sellers are slashing prices. About 27% of listings in Q1 2025 had price cuts, with the average reduction hovering around $16,000. Affordability is another red flag. The average household income in Avondale is about $70,000, yet with mortgage rates around 7%, a $385,000 home requires roughly $2,950 per month in mortgage, taxes, and insurance, over 50% of monthly income. That's far above the 30% rule that lenders and financial experts recommend, meaning many first-time buyers are being priced out or backing off. Meanwhile, new construction hasn't slowed. Thousands of new homes are still in development, especially around the Dysart and McDowell corridors. If demand doesn't keep pace, the market could be flooded with unsold inventory by late 2025. In short, Avondale is showing all the early signs of a localized price crash: overextended growth, affordability gaps, rising inventory, longer sales cycles, and declining prices. For those considering buying here, the numbers say proceed with caution. Number 9. Sun City. Sun City has long been a magnet for retirees, but in 2025, its once stable housing market is starting to wobble under economic pressure. Back in 2020, homes here could be snatched up for as little as $190,000. By the end of 2022, median prices had surged past $310,000, an increase of nearly 63% in under 3 years. Today, that same median is closer to $280,000, signaling a clear $30,000 plus correction from the peak. That's roughly a 10% drop, but more concerning is the speed at which homes are losing value. Sun City's buyer pool is aging, and with fixed-income retirees facing inflation and higher property taxes, demand is shrinking. Roughly 35% of homes sold in Q1 2025 came with a price reduction, averaging $12,500 off initial listing. At the same time, average time on market has tripled from just 15 days in 2021 to over 47 days in 2025. Interest rates hovering around 7% have dampened enthusiasm. Even a modest $280,000 home now costs around $2,200 per month in mortgage and insurance for a new buyer, far out of reach for many retirees living on Social Security, which averages about $1,900 monthly. Adding to the storm, many older homes in Sun City need significant upgrades. Built in the 1960s and 1970s, properties often require $30,000 to $50,000 in renovations just to meet modern living standards. That pushes total costs well above $300,000 for buyers who expected an affordable retirement nest. Sun City also has the second highest property turnover among Arizona retirement communities, with more than 9% of homeowners listing in the past 12 months, up from just 5% in 2019. This flood of listings combined with affordability pressure and a shrinking buyer pool creates a recipe for further price drops. In 2025, Sun City isn't collapsing, but it's undeniably cracking. Its affordability edge has dulled, and unless market conditions stabilize, deeper declines could be on the horizon. Number 8. Prescott. Prescott has long been hailed as a high-elevation escape with panoramic views and a charming downtown, but 2025 is revealing the dark side of its runaway growth. In 2019, median home prices were around $310,000. By late 2022, they exploded past $580,000, a stunning 87% increase. But now, Prescott's luxury market is undergoing a price reality check. As of 2025, prices have retreated to roughly $520,000, a $60,000 drop, or 10.3% slide from the peak. That's not all. Days on market have ballooned to 63 on average compared to just 21 days during the height of the boom. Roughly 31% of listings have seen price cuts in the last 6 months, with sellers slashing an average of $20,000 just to attract attention. The slowdown is especially painful in high-end gated communities, where $750,000 homes now sit unsold for months. Prescott's demographic makeup adds fuel to the downturn. With a median age over 57 and a large retiree population, rising healthcare costs and inflation are tightening wallets. Buyers from Phoenix and California who once flocked here with cash offers are now retreating as economic uncertainty and high mortgage rates squeeze budgets. Construction hasn't slowed either. Despite the cooling demand, nearly 1,200 new residential permits were filed in the past 12 months. Builders are offering steep incentives, up to $25,000 in buyer credits, to move inventory. That puts even more downward pressure on resale values. The affordability gap is growing too. With the average local income hovering near $55,000, affording a $520,000 home means spending over 60% of monthly earnings on housing, far beyond sustainable levels. In short, Prescott's charm hasn't faded, but its price tag is becoming harder to justify. With luxury inventory stacking up and migration inflows slowing, a further 5% to 10% drop seems very possible in the next year. Number 7. Goodyear. Goodyear was once the poster child of Arizona's suburban boom, but by 2025, it's rapidly turning into a cautionary tale. In 2020, homes averaged $320,000. By early 2022, that figure had soared to nearly $540,000, an eye-popping 69% increase. Fast forward to today, and prices have already dipped to around $485,000, a $55,000 drop, or roughly 10% correction from peak levels. What's driving the fall? Oversupply is a big culprit. Goodyear has greenlit more than 4,000 new homes in the past 3 years, but demand hasn't kept pace. With mortgage rates still sitting at 6.75% to 7%, fewer buyers are able to qualify. A $485,000 home now requires monthly payments over $3,600 when including taxes and insurance, well beyond reach for the average household income of $78,000 in Goodyear. Inventory has jumped nearly 50% compared to the previous year, and days on market have ballooned from 22 to 61. Nearly 30% of listings saw price reductions in Q1 2025, with sellers discounting an average of $18,000 to stay competitive. Even builders are offering $20,000 plus in rate buydowns and incentives to clear new inventory. Another risk is investor pullback. Many buyers during the boom were out-of-state investors, banking on appreciation in short-term rentals. But with Airbnb bookings down and local regulations tightening, many are offloading properties. That's adding even more supply pressure at a time when demand is weak. Goodyear's infrastructure is also struggling to keep up. Commute times are growing, public services are stretched thin, and buyers are starting to question whether it's worth paying $500,000 to live in what feels like a construction zone. Unless demand rebounds sharply, Goodyear could be staring down another 5% to 8% in price drops by the end of 2025. It's a classic case of a boomtown growing too fast for its own good. Number 6. Casa Grande. Casa Grande was once a hidden gem between Phoenix and Tucson, but its explosive growth has turned it into one of Arizona's most vulnerable housing markets in 2025. Back in 2019, median home prices were a modest $220,000. By 2022, they had surged to $390,000, an incredible 77% increase in just 3 years. Today, the market is already correcting, with prices now hovering around $345,000, a drop of $45,000, or about 11.5% from the peak. The city's affordability edge has eroded quickly. With average household income near $58,000, a $345,000 home now demands over $2,500 per month in mortgage, taxes, and insurance, more than 50% of gross income. That's squeezing first-time buyers out of the market, especially as mortgage rates hover around 7%. Inventory is ballooning. Listings are up 52% compared to this time last year, and days on market have more than doubled, from 23 days in 2022 to over 50 days now. About 35% of listings saw price cuts in Q1 2025, with the average reduction near $14,000. Sellers are clearly feeling the pressure. What's especially alarming is the level of ongoing construction. Casa Grande approved over 3,500 new housing permits in the last 2 years. Major developments, spurred by optimism around the Lucid Motors factory and potential tech investment, are bringing thousands of new homes online just as demand cools. But job growth hasn't matched expectations. While Lucid created a few hundred jobs, the broader employment boom never materialized. Without strong local job creation, demand will remain soft, and supply will outpace it. Casa Grande is now caught in a precarious balance: overbuilt, underemployed, and becoming less affordable. Unless economic momentum returns fast, home prices could decline another 8% to 10% by late 2025. For now, the numbers suggest a softening market with the potential for a sharp downturn if oversupply continues. Number 5. Surprise. Surprise, Arizona exploded onto the real estate scene during the post-2020 housing boom. With new subdivisions, parks, and big box retail growth, it was the ideal suburbia. But in 2025, that same growth is putting pressure on prices. In 2020, median home prices in Surprise were around $280,000. By early 2022, they reached nearly $480,000, a staggering 71% increase. But by mid-2025, prices have dipped back to about $435,000, losing $45,000 in value, or roughly 9.3%. Why the retreat? Affordability is waning fast. At 7% mortgage rates, buyers need roughly $3,200 a month to cover a $435,000 mortgage, with taxes and insurance. For the average Surprise household earning $76,000 annually, that's well beyond the 30% income threshold, pointing to a market out of balance. Inventory is climbing steadily. Active listings have surged 47% over the past year, and homes are sitting unsold for an average of 54 days, nearly triple the turnover time from 2021. Roughly 28% of all listings in Q1 2025 saw price cuts, with reductions averaging $17,000. Construction is still strong, with over 1,500 new homes added since 2023. Builders are offering aggressive incentives. Think $20,000 off list prices or full-rate buydowns to keep contracts moving. This new inventory competes directly with existing homes, forcing resale values to drop even more. Surprise also relied heavily on incoming migration from pricier parts of Arizona and California. But with inflation, stagnant wages, and tighter budgets, that buyer pipeline is slowing. Investor interest has also faded, with short-term rental revenue down and vacancy rates creeping higher. While Surprise still offers good schools, modern amenities, and master-planned communities, the real estate math is shifting. If current trends hold, the area could see another 6% to 8% drop in prices by 2026. It's not a collapse yet, but it's looking more and more like a bubble that's losing air. Number 4. Flagstaff. Flagstaff's scenic charm, high elevation, and cooler climate have made it a desirable escape from Arizona's desert heat. But in 2025, its red-hot housing market is beginning to show signs of distress. In 2020, median home prices in Flagstaff hovered around $420,000. By 2022, that figure ballooned to $685,000, a jaw-dropping 63% rise in just 2 years. As of 2025, prices have softened to about $615,000, a $70,000 decline, or roughly 10.2%. Flagstaff's affordability crisis is one of the worst in the state. The city's median household income is just under $65,000, yet a $615,000 home comes with a monthly mortgage burden of nearly $4,400, including taxes and insurance, nearly 80% of household income. That's beyond unsustainable for most full-time residents. Inventory has doubled since last year and properties are lingering longer. Average days on market has jumped from 21 to 58. Roughly 33% of listings have undergone price cuts, averaging $25,000 per reduction. Luxury homes and Mountain View properties, once snapped up within days, now sit unsold for months. Flagstaff's location also works against it. While it's beautiful and tourist-friendly, it's relatively isolated. As remote work declines and high-paying tech jobs consolidate in metro areas, the influx of affluent remote buyers is drying up. Many second homeowners are now offloading properties to escape high carrying costs, which is adding more inventory. Construction has remained steady, especially on the outskirts, but demand has tapered. Builders are offering deep discounts and closing credits, some up to $30,000, to compete with the resale market. Flagstaff still has its allure, but that charm no longer justifies the steep price tag for many buyers. If inflation persists and interest rates stay high, another 7% to 10% price decline could easily unfold by early 2026. What was once a mountain retreat is now a market on shaky footing. Number 3. Yuma. Yuma has always been one of Arizona's most affordable housing markets, but in 2025, that's starting to change. After years of modest growth, Yuma's housing market boomed in the pandemic era. In 2020, the median home price was about $210,000. By late 2022, it had jumped to $340,000, a staggering 62% increase. But now, prices have started sliding back to around $310,000, a $30,000 drop, or nearly 9%. Yuma's local economy relies heavily on agriculture, border trade, and government jobs. With limited high-wage job growth, local incomes haven't kept pace with rising home values. The median household income in Yuma is just $54,000. At current interest rates of around 7%, a $310,000 home comes with monthly payments of roughly $2,350, eating up more than 50% of gross income. That's simply not sustainable for most families in the region. Inventory is climbing fast. Active listings have surged over 45% since last year, and homes now linger on the market for an average of 52 days, up from 20 just 2 years ago. Over 32% of homes on the market have undergone price cuts, with an average reduction of $11,500. Another growing concern is investor activity. During the boom, many buyers from California snapped up properties as low-cost rentals or vacation homes. But with rental returns dropping and operating costs rising, many are now selling off, adding pressure to a softening market. Meanwhile, new construction continues on the city's outskirts, with developers offering incentives like $15,000 in buyer credits or full appliance packages to close deals. These perks undercut the resale market, pushing prices even lower. If current trends continue, Yuma may see another 5% to 7% correction before the end of 2025. Though still relatively affordable compared to the rest of Arizona, Yuma's market is wobbling under economic strain, high interest rates, and sluggish demand. A crash isn't guaranteed, but the warning signs are all over the spreadsheets. Number 2. Mesa. Mesa, one of Arizona's largest cities, is facing a sharp real estate recalibration in 2025. After riding the Phoenix metro boom to extraordinary heights, home prices in Mesa are now retreating. In 2020, the median home price in Mesa was around $290,000. By mid-2022, it hit nearly $510,000, a 76% surge in just 2 years. But as of 2025, prices have dipped to around $465,000, shedding $45,000 or 8.8% from the peak. Affordability has evaporated. With average household incomes in Mesa around $72,000, the cost to finance a $465,000 home at a 7% interest rate sits near $3,400 a month. That's well above the 30% income to housing rule, putting strain on working-class buyers and middle-income families alike. The market has also flipped in terms of supply and demand. Inventory is up 50% year over year, and the average days on market has ballooned from 19 days in 2022 to 56 days in 2025. Over 30% of current listings have had price cuts, averaging $19,000 per home. Homes that once sold in a weekend are now struggling to get viewings. The new construction boom hasn't helped either. Large-scale developments around Eastmark, Desert Ridge, and the Gateway Corridor have added thousands of homes, many of which now compete directly with existing resale properties. Builders are offering $25,000 in concessions or 3-2-1 mortgage buydowns to keep their pipelines moving. Investors who made up a significant portion of purchases in 2021 to 2022 are now cashing out. Mesa was a top market for iBuyers and institutional landlords, but as rents cool and returns shrink, many are selling off, flooding the market with even more inventory. While Mesa remains a desirable place to live, especially for families and retirees, its market fundamentals are weakening. If interest rates remain elevated and wage growth stays flat, Mesa could face another 6% to 9% price decline by mid-2026. Number 1. Phoenix. Phoenix was ground zero for Arizona's pandemic-era housing boom, and now it's at the heart of the correction. In 2020, median home prices in Phoenix were around $310,000. By mid-2022, they had rocketed to $535,000, a jaw-dropping 72% increase. But by 2025, prices have already dropped to approximately $480,000, shaving off $55,000 or just over 10%. Phoenix's affordability is collapsing. The median household income is about $71,000, but monthly payments on a $480,000 home at 7% interest now exceed $3,500, including taxes and insurance. That's nearly 60% of gross income, well above any healthy financial benchmark. Inventory has exploded, up nearly 55% since last year, and homes are now sitting on the market for an average of 62 days, up from just 17 during the 2021 frenzy. Nearly 35% of all listings saw price cuts in Q1 2025, with average reductions over $21,000. Some neighborhoods have seen declines exceeding 15% from peak values. Phoenix's new construction pipeline is also a problem. Thousands of units continue to hit the market, especially in the West Valley and northern suburbs. Builders are offering $30,000 incentives or full closing cost coverage just to compete, putting massive downward pressure on resale values. Investor pullback has amplified the problem. During the boom, Phoenix was a national target for institutional buyers, iBuyers, and out-of-state flippers. But with rental prices stagnating and home appreciation slowing, many are dumping properties, often below market, just to exit. At the same time, population growth has slowed. With rising crime concerns, heat waves, and a growing affordability crisis, some buyers are fleeing to smaller markets like Prescott or Casa Grande. Job growth remains decent, but it's no longer enough to prop up runaway prices. Unless rates fall or demand rebounds, Phoenix is on track to lose another 7% to 10% in value by late 2025. It's not just a cool down, it's a full-blown market correction in Arizona's biggest city.